For this upcoming week, AMC has 343,000 calls that are out of the money. AMC also has only 3,000 calls that are currently in the money. That is less than 1% of the total call activity that is in the money. Can we see a move to the upside that starts to force some of these contracts into the money? That's what we're going to talk about here in this video, because I think we will actually see a bullish week this week, and I think we do stand a chance of seeing a gamma squeeze. And that's only just the call side. The put side of this is very bullish as well. We have 112,000 puts that are in the money, 38,000 puts that are out of the money. So I want to go over the option chain with you. I want to look at the technical analysis, give you guys the overview of where we currently sit, if we could possibly see a gamma squeeze, how I would look to trade this, and why I think we could actually see a rally throughout this week. So if that is something you guys are interested in, make sure to stay tuned throughout this whole video, but also hit the like button and subscribe to the channel. If you guys want to support the channel, links for free stocks down below in the description with Webull, Moomoo, and Public. Right now, Moomoo is doing a special promotion. When you sign up and deposit $1 single, you will get 3 free stocks, as well as an additional free share of NEO upon your deposit clearing. So check that out if you guys have not already. And if you want to come join the trading community and trade with us live, ask your questions. If you want to get into options, you don't know how or where to start, you want passive income, you want to play aggressively, that is your place to do that. Link down below in the pinned comment. Nonetheless, let's get into this information. And before we get into the actual Stocko tracker numbers, because they look better than they have really ever in a very long time. And why I say this is because we've never really seen a time in AMC's history over the past year where you only had 1% of the total call activity that was currently in the money heading into a brand new week. You quite frankly have never seen that. That is a very low ratio. 3,000 contracts that are in the money, 343,000 that are out of the money. Give me a break here. We've never seen that. So to say we could not see a gamma squeeze, I think is just being too narrow-minded and not opening your mind up to the possibilities here. Same thing on the put side as well. But like I said, we will get into that more in just 1 second. Most importantly, we need something to push the stock up. And more importantly, the broad markets as well, because AMC very rarely tends to rally and see big days without the markets also rallying. Now, we can make a whole video on why that is, but that's not as important. What is going to cause the markets to rally? In my personal opinion, and feel free to let me know your opinion on this down below in the comment section, but I think it comes down to the Fed, which the Fed meeting is on Wednesday at 2 p.m. I think it's possible to see a green day on Monday or Tuesday, just because that's typically what we see. If you have a Fed meeting middle of the week on Wednesday, you will typically see at least one green day on Monday or Tuesday. I don't think that would necessarily cause a gamma squeeze, though. What I think is going to happen Wednesday at 2 p.m. is the markets are expecting a very hawkish Fed for good reason. CPI just came in at 7.9% year over year, the highest inflation numbers we have had since August of 1982. So for good reason, people think the Fed is going to be hawkish. But a lot of people don't fully realize Fed Jerome Powell just said last week during his testimony to Congress or to Senate, he said that the Fed controls demand. If there is a demand issue, then hey, that's where the Fed can step in and bring down demand, thus bring down inflation. But by and large, you have already seen quite a few rate hike increases already priced into the markets. You can see that by the 10-year Treasury yield. If you just simply go to CNBC, go to bonds, look at the 10-year Treasury bond, you could see the rate's almost at 2%. This rate was at 0.5% during COVID. This rate just a couple months ago was at 1.5%. Markets have effectively priced in about 2/4 point rate hikes. 0.25% rate hikes. So we got that, right? But the markets right now are expecting a rate hike every single meeting. The March 16th, the May 4th, the June 15th, the July 27th, the September meeting as well, and it doesn't really change up until November. Then nobody expects really that additional rate hike, or at least 44.5% of investors don't expect an additional rate hike by November. So virtually the next 5 meetings, people are expecting a rate hike every single time. But remember back to what I just said. This is not really a demand problem. The markets have already priced in rate hikes. The economy is starting to slow down. Growth rates of companies are starting to be slashed. Companies are having earnings 2, 3, 4 weeks later coming out and revising on their guidance, guiding down because of either geopolitical tensions like McDonald's shutting down 800 restaurants in Russia and losing $50 million per month. Companies are starting to guide down. So the economic outlook is being reversed. It's not getting better. The outlook is not getting more bullish, or you're not seeing more growth priced into the markets in that aspect. But people magically think the Fed is still going to be incredibly bearish. Sure, the Fed's job right now is to show that they will do something about inflation. That's why they have committed, like Fed Jerome Powell said in his testimony to Senate just last week, that they are going to raise rates by at least 0.25% in March. But let me be straightforward with you guys. The situation we're seeing with Russia essentially taking all of their assets and their whole entire economy to zero, that contagion is spreading throughout Europe, China, and lastly, America. The economies are interconnected. The Fed knows this. If the Fed raises rates 5 times the next 5 meetings, we are going into a deep recession. That is not a soft landing. So I think the Fed will obviously raise rates 0.25% this upcoming Wednesday, but I think it's very clear, at least to me, the Fed is either going to be not transparent about what they're going to do next, which will be a bullish thing, or the Fed's just going to say, hey, there's a lot of uncertainties around the world. We don't want to crush markets, push us into a recession, and we're going to take things slow. That, again, would be a bullish thing. The only way the markets are going to sell off after the Fed meeting is if the Fed comes out and says, hey, we're going to have to do a 0.5% rate hike because inflation is just really high and there's a lot of demand out there. The economy is doing good, which that is a possibility. But then again, I think the Fed knows they would push the markets into a recession. What I'm saying here is if you want to see the markets going down after the Fed meeting, you need to hear something that is not priced in. If the markets are expecting 5 rate hikes every single meeting for the next 5 meetings, the Fed's going to have to say something else besides, we're going to raise rates 0.25% every meeting. Even if they said that, the markets would be fine with it because it's already priced in. Like I said, if they say something crazy, that's where the markets would have a hissy fit, and that's where they would sell off. If it's anything more dovish than 5 rate hikes in the next 5 meetings, the markets will rally. And I think that is the only logical conclusion to make from all of this. And yes, I will be putting my money where my mouth is. I will likely buy some AMC calls, buy some AMC shares, as well as trades in the broad markets based off of my bullish thesis around this Fed meeting. And if you guys want access to all of those trades in real time, link down below in the pinned comment, like I said. So that is why I think it's pretty damn clear here. The markets are going to rally after that Fed meeting Wednesday. We could have a green day. I expect a green day either Monday or Tuesday, and then I expect a red day. Or just we could have 2 flat days. I really don't expect anything too crazy until that Fed meeting because all of the excitement, all of the, the potential fear or greed will be bottled up until we get clarity from the Fed because nobody wants to act first and be wrong. It's better to be late than wrong is what they say on Wall Street. Okay. So you guys got that. That's very important. That's why I had to put this out here because it pertains directly to this upcoming week. Now, like I said, we have a very large amount of calls that are out of the money compared to in the money. Same thing for the put side. Now, how does this hold up to what we are seeing on the actual option chain? We do have a lot of contracts that are at that $95 expiration, about 85,000. But at the same time, we see a lot of open interest that is just out of the money as well on the call side, but especially on the put side as well. So you are seeing about 4,000 contracts that are held for open interest at the $15 call. Okay, that shouldn't be too hard to get to. 1,300 at the 15.50, about 6,000 at the $16 call, 5,300 at the $17 call, 1,500 at the 17.50, about 5,600 at the 18, 2,000 at the 18.50, about 6,000 at the 19, 1,300 at the 19.50, and about 16,000 at that $20 strike. So if you add this up, that's roughly 40,000 calls that are out of the money, that are in open interest up until that $20 strike. And I think that is very reasonable to see a quick squeeze up to that $20 strike. Because, hey, we were just at $20 not too long ago. It's not going to take a whole lot to get us back up to there. Because after all, who is selling AMC right now? It's probably not a lot of people. Is probably a lot of shorting that happens, because like I've said in many videos, at certain points, these stocks that are beaten into the ground really don't have that many sellers left, or any sellers left, of people that are willing to take their massive losses and walk. Anybody that was going to do that already probably sold out of AMC already, or just any other stock that is beaten down. A lot of this selling pressure comes from shorts, and that goes for AMC and a ton of other stocks. So 40,000 roughly calls that are held in open interest up until the $20 strike. That's 4 million shares that would have to be bought by the market makers. And especially if that happens on Wednesday and Thursday, you're not going to see much time until Friday. So it's going to have to happen pretty much instantaneously, because, hey, after all, the premium is very cheap. So if you bought this $20 call for this Friday, that costs you $8. So the market makers would have to hedge out these options if the stock price went to $20, 8 cents per share, or they would lose money. So they have to hedge them out very soon. Very, very soon. Literally as soon as they come close to going into the money or go into the money at all, even a couple pennies, they have to hedge that out, because that is massive liability and massive risk on the market makers. Now, the put side is very interesting. We are seeing a lot of $15 puts that were placed on Friday, about 27,000 for volume at the $15 strike. So if this goes against the hedge funds in a big way, they're going to be feeling a lot of pain. You have about 19,000 for open interest at that $15 strike, 8,300 at the $14.50, 2,000 at the $15.50, 14,000 at the $16, 2,000, 1,700, 1,000, 7,000, about 1,000, 2,500, 500, and 53,000. So you actually have more puts that are in the money right now that are up until that $20 strike. So that's about 60,000 on the put side. About 60,000 for open interest. That's about 6 million shares that would have to be bought by the market makers. That in all is about 10 million shares that would have to be bought by the market makers. And if you take a look at the volume that we see on any given day, it's very low, especially what we've seen over the past couple of days. The past 2 days, really all of last week, we were sitting around 25 million shares that traded hands on any given day. On Friday, we did see 29 million shares that traded hands. But relatively speaking, that is a very low number, and that would be half of a day's volume if we seen that move to the upside to about $20 per share. I think that is very possible, and I think if we get over 20, we could actually see a boost much higher, unless the shorts come in and short the stock into the ground. But if Fed Jerome Powell gives this dovey outlook, then it doesn't make a lot of sense to short a stock, just like in 2020 when the Fed was super accommodative and there was no end in sight for the money printer. You were out of your mind to be shorting stocks like this. That's what happened with GameStop and AMC. Money printer was going burr and people were shorting stocks into the ground. Hedge funds got blown up. So if the Fed, doesn't give people a reason to continue to short these stocks, then I think it will be really good. And I really don't think he's going to at this current moment. On top of that, the max pain is sitting at, let's go ahead and pull this up. I gotta pull up AMC. I had SoFi up. Max pain sitting at, for this week, $20. And if you guys are unfamiliar with what the max pain is, the max pain or the max pain price is the strike price with the most open options contracts. And it is the price at which the stock could cause financial losses for the largest number of option holders at expiration. So, pretty clear. Hedge funds, market makers, they like to get that stock around the max pain price. That is $20 by this Friday. So I think all in all, putting 2 and 2 together, it could be really good. And I will probably buy some cheap AMC options, look at it like a little YOLO, because, you know, if you have a couple bucks to do that, I don't like to buy lottery tickets. So I think that's a good move for my situation. I really believe in what I'm saying to you guys, but we definitely need to get back up above $15 per share. That's the key level, and I really think we will. We've seen a lot of demand under 15 and a lot of strong support under 15. The days that we have dropped under that, we have quickly recovered. So I do expect that to happen probably on Monday, if not on Tuesday. The RSI is also almost at oversold territories. We've only went oversold technically under 30 right here. And that was during this dip when we went to about $13 per share, started to come back up, and we've never really went oversold ever. So once you get close to these levels, you do tend to rally off of that 30 on the RSI mark. MACD, pretty neutral, nothing to point out there. Like I said, $15 for the support level that I think will come back to us. Could be a little bit of a resistance. We're just going to have to see. A lot of those $15 puts were placed today, about 27,000 for volume. So you definitely seen a lot of artificial shorting, and we're going to have to see how that does play out. The 20-day moving average is at $17.32 per share. That's going to be another very important level. And then we should be clear to go back to 1850, in between 1850 and $21 per share before we get that next level of resistance around 21 per share, like we seen back here on February 10th. So I think the situation is very bullish. Let me know your thoughts on all of this down below in the comment sections. Thank you guys for watching. Hit the like button, subscribe to the channel, get those free stocks. Links down below in the description for Webull, Moomoo, and Public. And come join the trading community. Link down below in the pinned comment. Thank you guys for watching, and I will see you in the next one.